Welcome to our channel where we help you understand the world of finance. Today we're going to delve into a subject that's on the minds of many. What are the risks of individual stock investing? Cons you should consider. It's a question that's worth pondering, whether you're a seasoned investor or just starting your journey in the stock market. Investing in individual stocks can be an exciting prospect, offering the potential for considerable returns. But it's not without its risks. It's crucial to understand these risks, to make informed decisions and safeguard your hard-earned money. We're going to explore these risks, from the chance of losing your investment, to the dangers of not diversifying, the time and knowledge required, emotional investing, and the impact of market volatility. So whether you're looking to invest in individual stocks or already have a portfolio, this discussion is for you. Stay tuned as we delve into the cons you should consider before investing in individual stocks. First up, the risk of losing your investment. Investing in individual stocks carries with it a stark reality, a reality where the possibility of losing your entire investment looms. Yes, it's true. If a company in which you've invested goes bankrupt, there's a chance you could lose everything you put in. This is not a scenario to be taken lightly, especially when your hard-earned money is at stake. Now, you might be wondering, why is this risk higher with individual stocks? Well, when you invest in a single company stock, your financial fate is tied to the fortunes of that one enterprise. If the company thrives, so does your investment, but if it fails, your investment goes down with it. You're essentially putting all your eggs in one basket. On the other hand, let's consider mutual funds or exchange-traded funds, commonly known as ETFs. These financial instruments pool together investments from many people and use that pool to buy a wide variety of stocks, bonds, or other assets. When you invest in a mutual fund or an ETF, you're not putting all your eggs in one basket. Instead, you're spreading them out across many baskets. This diversification can help protect you from the failure of any one company, industry, or even country. However, it's important to note that diversification doesn't eliminate risk entirely. Even mutual funds and ETFs can lose value if the overall market declines, but the risk is generally lower than with individual stocks because you're not relying on the success of a single company. So the risk of losing all your money is a significant con of individual stock investing. It's a risk that needs to be carefully considered and managed. But remember, every investment carries some level of risk. The key to successful investing is understanding these risks, so you can make informed decisions about where to put your money. Next, let's talk about the lack of diversification. Now imagine you're at a buffet, and there's a smorgasbord of delectable dishes laid out. But instead of sampling a bit of everything, you pile your plate high with just one dish. Sure, it might be your favorite, but you're missing out on a world of flavors. The same principle applies to your investments. Diversification is the financial equivalent of trying out different dishes at a buffet. It's about spreading your investments across a variety of assets to reduce risk. The idea is simple. Don't put all your eggs in one basket. If one investment doesn't perform well, you won't lose everything because your other investments may be doing just fine. But when you invest in individual stocks, achieving true diversification can be quite the challenge. For starters, you need a significant amount of capital to buy enough stocks in different sectors and industries to spread your risk. And even then, there's a catch. The performance of individual stocks can be heavily influenced by industry trends, economic factors, and company-specific news. So, even if you own stocks in different sectors, if they're all affected by the same macroeconomic factors, you're still at risk. Moreover, diversification isn't just about having a mix of stocks. It also involves spreading your investments across different types of assets, like bonds, real estate, and commodities. But if you're heavily invested in individual stocks, you may not have enough capital left to invest in these other assets. The lack of diversification can lead to higher risk. If you've invested heavily in one stock and that company goes under, you stand to lose a significant portion of your investment. On the other hand, if you're diversified, a single company's downfall won't wipe out your entire portfolio. In essence, diversification is like a safety net. It may not always prevent losses, but it can certainly cushion the fall. So when you're investing, don't just go for your favorite dish. Sample a bit of everything. Remember, putting all your eggs in one basket can lead to significant losses. Another con to consider is the time and knowledge required. When you're thinking about investing in individual stocks, it's crucial to recognize that this isn't a passive endeavor. This is a game that requires active participation and a keen understanding of the financial world. Firstly, let's talk about research. Before you even consider buying a single share, you need to do your homework. You'll need to delve into a company's financials, scrutinize their balance sheets, and analyze their cash flow statements. You'll need to understand their business model, their competitors, and the industry they're operating in. You'll have to stay updated about their latest news and be on top of any changes in their leadership or strategy. This is no small task, and it can be a full-time job in itself. Next, there's the ongoing monitoring of the market. Investing in individual stocks isn't a one-and-done deal. It's a continuous process that requires you to keep up with market trends, economic indicators, and various other factors that can influence stock prices. You'll need to keep a close eye on your investments, be ready to make adjustments as needed, and know when to cut your losses. All of this requires a substantial amount of financial knowledge. You'll need to understand concepts like price-to-earnings ratios, dividend yields, and market capitalization. You'll need to be familiar with financial jargon and be able to interpret complex financial statements. If you're not financially literate, it's easy to make missteps that could cost you dearly. But perhaps the most daunting aspect is the sheer amount of time all this takes. Time to learn, time to research, time to monitor. It's not just about having the time, but also about being willing to devote that time. If you're already stretched thin with work, family, and other commitments, finding this time can be a challenge. Individual stock investing is not for those who want a set-it-and-forget-it type of investment. It's for those who are willing to invest not just their money, but also their time and effort into understanding and navigating the complex world of the stock market. Let's address emotional investing. Now, imagine this. You've just heard about a hot new stock from a friend. The company sounds innovative, the CEO charismatic, and the potential for profit tantalizing. Excitement bubbles up, and before you know it, you've invested a good chunk of your savings into this single stock. This scenario underlines a significant risk associated with individual stock investing: emotional investing. It's a term that describes making investment decisions based on feelings rather than cold, hard facts. It's a trap that's all too easy to fall into, especially when you're dealing with individual stocks. Remember, the stock market isn't a casino, and investing isn't gambling. It's not about hunches or gut feelings. It's about research, analysis, and making informed decisions. When you let your emotions guide your investing decisions, you're more likely to make impulsive choices. And these choices, more often than not, can lead to financial loss. Think about it. If you're driven by fear, you might sell a stock at the first sign of a price drop, potentially missing out on future gains. If greed is your driving force, you might hold on to a stock long after it's prudent to let it go, hoping for an unrealistic windfall. Emotional investing can also lead you to overlook the fundamentals. You may ignore warning signs like a company's poor financial health or an unstable market, simply because you're emotionally attached to a particular stock. This can result in a significant financial hit. So how do you avoid emotional investing? Well, it's all about discipline. Stick to your investment plan. Make decisions based on thorough research and analysis, not on the latest buzz or your emotional state. And remember, it's okay to seek advice. Financial advisors, investment clubs, and even automated investing platforms can provide objective insights and help keep your emotions in check. In conclusion, emotional investing is a significant risk associated with individual stock investing. It can cloud your judgment, lead to impulsive decisions, and ultimately result in financial loss. Emotional investing can lead to poor investment decisions, another con to consider. Lastly, we have market volatility. This is a term you may have heard, especially if you've been keeping an eye on financial news. But what does it mean? Simply put, market volatility refers to the rate at which the price of an asset, in this case individual stocks, increases or decreases for a set of returns. When we talk about individual stocks, they are particularly susceptible to this volatility. Why is this? Well, the price of a single company's stock can be influenced by a myriad of factors. These can range from internal events such as earnings reports or executive changes, to external events like geopolitical unrest, changes in industry trends, or even shifts in investor sentiment. All these factors can lead to significant fluctuations in the value of your investment. One day, your stock could be riding high, and the next, it could take a nosedive. This unpredictability can be nerve-wracking for investors, especially those who are new to the game or those who have a lower tolerance for risk. You see, unlike diversified investments, where risks are spread across different assets, individual stock investing places all your eggs in one basket. This means that when the stock price fluctuates, the value of your entire investment fluctuates along with it. It's like being on a roller coaster ride. Some might find this thrilling, but for others, it could cause sleepless nights. It's essential to remember that while market volatility can offer opportunities for high returns, it also presents the risk of substantial losses. So, before you dive into individual stock investing, it's crucial to understand your risk tolerance and investment goals. In conclusion, while individual stocks can potentially offer significant returns, they are also subject to high market volatility. This can lead to considerable fluctuations in the value of your investment, making it a less stable option compared to diversified investments. So it's always wise to do your homework before you invest. Market volatility can cause a roller coaster of emotions and is another con of individual stock investing. Those were some of the cons of individual stock investing. Let's take a moment to reiterate and fully absorb the risks we've just discussed, to truly appreciate the gravity of these factors. Firstly, the risk of losing your investment. Remember, stocks are not immune to the laws of gravity. They rise and they fall, and sometimes they might not bounce back up. It's vital to understand and accept this risk before diving headfirst into the stock market. We then discussed the lack of diversification, which is akin to putting all your eggs in one basket. If that one stock fails, your entire portfolio takes a hit. Diversification is a key strategy in mitigating risk, spreading your investments across various sectors, industries, and asset classes. Then, there's the time and knowledge required. Individual stock investing isn't a passive activity. It demands time, research, and a deep understanding of the market. Without this, you might find yourself navigating a labyrinth without a map. We also touched on emotional investing. Our emotions can often cloud our judgment, leading us to make impulsive decisions. Investing should always be a calculated move, not an emotional reaction. And finally, market volatility. The stock market is a roller coaster ride with ups, downs, twists, and turns. It's not for the faint-hearted. It requires resilience, patience, and a stomach for risk. In conclusion, while individual stock investing can offer high rewards, it is not without significant risks. Understanding these risks is crucial in making informed decisions and mitigating potential losses. It's not about avoiding risks, but about knowing how to manage them. Thanks for watching. Don't forget to subscribe to our channel for more financial insights. See you in the next video.